Welcome to Infrastructure Week, where we cover all things lending tech and transformation. I'm Dave Silverstein, founder and CEO of NED. Welcome back to Capital Compass. I am very excited to have this particular guest join us as part of our Infrastructure Week series. Welcome to Kevin Fryatt, the Co-Interim CEO at the Washington Area Community Investment Fund, also known as WACIF. I've gotten to know Kevin over the last year. We often chat on a number of trends, tech topics in and around the small business lending space. Kevin, welcome. Great to have you.
Great to share a little bit of time, Dave.
Awesome. So Kevin, diving into WACIF, would love to just get, broad strokes on the organization at large. Tell us a little bit about what you're focused on in your role today. What are some of the areas of growth that you're looking at and focusing on for the 2024 year?
Sure. Yep. So maybe a little bit of history as well.
Yeah,
I think
please.
it speaks to I think the context, some of the backdrop, and sort of the trajectory that we're on. So, like a number of CDFIs founded in the late '80s, kind of around church basements and trying to dream up ways to get capital into the communities that we live. Fast forward a number of years. So I've been with the organization for 6.5 years. I joined in 2017, and so here I am now as the co-interim CEO, but I joined as a director of finance, kind of moved into chief financial and operations officer, and now into an interim leadership position. But I think what has characterized our work, and just at a very high level, like our mission is increasing equity and economic opportunity in the greater Washington, D.C. area. There's three primary pillars that really kind of define the hallmark of our work. And this is kind of our core belief that entrepreneurs thrive when they have three different things, and that's social capital.
Yeah.
So the connection with each other, with other entrepreneurs who are going through similar things, connection, kind of that sort of shared experience, knowing that you're not alone. Knowledge capital, this the technical inputs to running and growing a business. So whether that's the marketing support, the accounting, finance, like this sort of thing, growing your business. And then kind of the financial capital. So these are sort of the three capitals that we often refer to. So, and the financial capital is the one that I think gets a lot of the attention. I think if you talk to an entrepreneur, that's obviously important, but I think not necessarily at the mitigation of any of these other two.
Certainly.
So
Yeah.
we sort of see them as a three-pronged kind of formula for success. So as an organization, I think we offer like financial services, advisory services, and then some of that social capital piece, a lot of kind of collaboration between folks in the industry, the entrepreneurs themselves. Hasn't always been that way. I think in our early years, we did a lot of different things. Affordable housing was a place that we played in early on. And I think with when I came on board in 2017, and our CEO at the time, Harold Pettigrew, who's now leading the Opportunity Finance Network, really solidified our place in the small business ecosystem. Like in the Washington, D.C. area, and we're a regional CDFI, Washington, D.C., Maryland, Virginia. But in the greater area, like a really great reputation for the work that we've done in the community, but like we hadn't really scaled ourselves. Like when I joined in 2017, we had a $4.5 million balance sheet. Fast forward to today, we got a few different entities under the umbrella, but we have a balance sheet roughly of $25 million plus or minus. And in recent years and really recent months, I would say a growing loan portfolio, which is something that we couldn't necessarily claim over the course of our existence. Our lending had stayed relatively flat, and that was driven largely by just manual process, and and manual process, manual underwriting, struggles with systems, kind of all these kind of dynamics that you would characterize with an institution that's been around for a while, but it hasn't really kind of seen itself to higher things. So that's sort of that's where we are now is so after I came on board in 2017 and being kind of the operations guy, the finance guy, a focus on systems, a focus on process, a focus on efficiency, these sorts of things. And more recently, really a fundamental shift in how we do lending, and through the lens of kind of a digitization of information, of process, et cetera, really with an aim to scale our work. So yeah, that's a high level nutshell.
That is the
Happy
nutshell. That's a big nutshell.
that is a big nutshell with a lot that fits underneath that. But
For sure. And I definitely am going to go into what you're talking about in terms of general operating transformation. But I want to actually talk a little bit about your experience before WACIF, which I find to be fascinating. You've worked globally in a number of different capacities in and around the financial empowerment space. I'm curious if you could share a little bit about that experience and what, if anything, did you learn abroad in all of the different locations that you've kind of spent time, and how do you bring that back to the Washington, D.C. area?
yeah, so I spent, so my background, I have an undergrad in business. And it took me 4.5 years of getting a business degree to realize, and with a specialization in accounting, that I really didn't want to be kind of holed up at a big four accounting firm for the rest of my life. So yeah, I ended up getting a master's in international development, and that was sort of at the same time as kind of working internationally. So yeah, and then found my way into microfinance. So I think some of my early career was in post-conflict environments where I saw the devastation, I think, that was
Yeah,
caused not just by conflict, but actually by the aid that was perpetuating cycles of just perpetuating the reality that folks were in, not bringing them out of what they were in, but just perpetuating dependency and this sort of thing. And I remember the last I was in West Africa at the time, and the last sort of aid work, if you want to call it that I was doing, where my mind was at was, okay, I like helping, like I like being part of the solution, but there's got to be a better way of doing this.
mm,
And then I ended up kind of through contacts that I had, landing a job in Baltimore that was part of a global network of microfinance institutions founded in post-conflict environments, this sort of thing, and really enjoyed the work of building things. And that was at a time in the international space where Muhammad Yunus had just won the Nobel Prize. The UN kind of named it the year of microfinance in the early 2000s. And so there was a lot of attention on this space and a lot of development and growing up that happened, professionalization of the space. So it was a lot of institution building. And that was, I think, what I really enjoyed at the time, was building businesses, building sound financial institutions, leaving things better than they were when I found them, all
sure.
these sorts of things. And I think a lot of the professionalization that I saw happen and the scale that happened as a result of that was something that I didn't find when I transitioned 6.5, 7 years ago out of the international space into the domestic space, where CDFI space, long, rich history of doing really quality work in the US, and having been around as a sector for 40 odd years, the question I always ask myself, well, why haven't we figured things out by now? Because there's still so much need, there's still so much possibility, and but I think finding a space where the technology providers weren't there wasn't a great array of folks to go to, and there wasn't standards that folks
Yeah.
followed in approaches to operating a financial institution, financial ratios that everyone tracked, loan product methodologies that were standardized because someone had tried, tested, and had a tried, tested, and true approach to doing something. So everyone's figuring it out as they go. But so it feels like, or it felt like 6.5 years ago, kind of where the international space was 15 or 20 years ago. But a lot of scale had been reached internationally with a lot of creative approaches to um, building institutions, funding institutions, creating new financial services. And these institutions internationally and in the US started in a similar way, credit only institutions. But you look at where the international microfinance sector has gone, these credit only institutions were faced with these dynamics of, well, I've worked with my client for the last 5, 10 years and I've helped them grow. Why would I just pass them on to a bank when I've invested all those resources? So you ended up seeing credit only institutions becoming banks, and
Hmm.
regulators had to create the regulation. They started mobilizing deposits because they needed cheaper funding sources. And the industry grew from there, and it's now folks are providing insurance and foreign currency services, and you name it, like deposit accounts and all these types of services that a growing small business is going to need. I think the other thing is kind of my motivation for the work, I guess, is sort of centered in, and I didn't realize this, I think, early on in my career. But it's like my dad's an entrepreneur, but he knew how to make money. He didn't necessarily know how to manage it.
Hmm.
So bankrupt twice due to kind of reliance on credit card debt and getting in kind of a spiral of high cost debt. And I think, like, as I've gone through my career, I've realized that, wait a minute, I know I'm in this work for a certain reason. I think it's started to become clear to me over the years where it's like when things, and coming through COVID, I think crystallized that for me as well, where the work can be pretty hard. So you better have a deeper motivation for doing this stuff than collecting a paycheck, because like when it gets tough, you got to remember what you're here for. So for me, it's a lot of yeah, providing access to financial services to folks like my dad who, and when it comes to like the knowledge capital and these sorts of things, it's the financial capital, but it's the knowledge piece. This is the thing that he was missing. He didn't have
Sure.
the connections, the availability, the know-how to manage his business, manage his finances, and as a result, kind of ended up going down this path of bankruptcy. So being able to provide that for others, being able to kind of support folks like my dad who are trying to figure it out, and like the idea of entrepreneurship and being able to find your own way and create things and this sort of thing, but also doing it at a pace that's sustainable and something that can grow into the future. So
Awesome. And so you've now, you've seen kind of the transformation and growth of international microfinance and lending. You're seeing quite a lot of change now here domestically, and you've been part of both stories from different vantage points. And in just even mentioning the growth metric of WACIF alone over the last couple of years, scaling to $25 million balance sheet in a relatively short amount of time, it comes from somewhere. I'm curious, as you think about the investments, not just money investments, but in technology investments, time investments, that have been made over the last couple of years, where have you focused, or where has the WACIF team focused to really enable you to grow in that direction? What are some of kind of the key areas that have been central in that story?
yeah, that's a great question. I think first, it's been a number of things, but I think when I first came on board, under Harold's leadership early on, is really a changing of the culture. So
Mm.
you don't grow with a within a stagnant culture. Like you have to be unsettled when things are not working the way they should and the way that you know that they need to. So I think starting with Harold, myself, other folks that we brought on, um, really were wired in many of the same way. Whereas, and I remember telling some teammates at the time, like, hey, we're not going to change things by, it's not one big project that we're going to launch and that's going to catastrophically change how we operate. This is every single task that we do, we can build in a little bit of efficiency every time we do that
Hmm.
task. So the next time you do it, you're 20% quicker and this sort of thing. And those are the things that, and that's at a very kind of minute level, but I think if you raise that up to systems or greater efficiencies, it's like we can't get comfortable with where we're at. Like we always have to be thinking of the next best way of doing things. So I think where that played itself out, as the culture shifted, was also a like a license to change things. So it wasn't like this was not uh, staying stagnant was not glorified. It was
You
sort of
had
the opposite.
permission. You had kind
We
of
had we had
permission.
we had
Yeah,
full permission to
that's great.
change things, and not only permission, like at an operational level, but we had people backing us.
Hmm.
We had one, and we've obviously been very fortunate from a fundraising perspective as well. We had a foundation here in the DC area early on that said, "Hey, here's $1 million, unrestricted grant. Go build the institution that you want to build, and what you see 5 to 10 years from now." This is a very privileged place to be. It's not the story of every nonprofit. I think Mackenzie Scott might be changing some of that narrative a little bit, but that was not our reality. But we did have a primary supporter in the early days that allowed us to say, okay, we're going to spend $30,000 a year on putting a new core accounting system in place. We're going to
Mm.
spend another 10 putting this function in place and this function, and we just started kind of knocking them out one at a time. So it was a new CRM system, and then and so we basically, and this is coming through 2018, coming into 2019. I think we went live with our accounting system like in September, I think it was, of 2019. And this is with like broader visions of kind of growing out the umbrella of WACIF brands, and really knowing some of these core things that we just need to get into place. This is
Yeah.
not anticipating a global pandemic or anything like this. But the timing was impeccable because here we are, and at the time we're 9 staff, come early 2020, and boom, the pandemic hits. Meanwhile, we've already digitized a lot of our activities and our operations, so working remotely wasn't as big of an issue for us. And we were able to churn. So we were able to kind of leverage the systems that we had in place at that time to churn a lot of the volumes of money that we managed, and for district government agencies or other folks during the pandemic, to really keep small businesses on their feet. But the last one that we're still working on now, but it was sort of the last holdout, if you would, internally, but just
Yeah.
because of the enormity of it, was our lending function.
Hmm.
And we had sort of on average capped out at around $2 million of loan production a year, which in my view is unacceptable given the amount of need and demand that's out there. Um, and but you needed the know-how, you needed the support, you needed the band of the team, all these different factors. And we ended up at the time, a couple of years ago, recruiting a former colleague of mine from the international space, to come in and work with WACIF as well, because I think getting the institution to a place where we can think differently about, like, can a lending function in the United States that does this type of small business lending be a financially sustainable thing. Not if we continue to do the same thing that we've done. Like that's the definition of insanity. That's not a definition
And
of a
what was
solid
this?
vision.
What was the same thing? Was it because what I'm hearing is kind of simultaneous change where you're looking at foundational infrastructure when you talk about CRM or when you talk about accounting systems. Like that's like the base that you need. But then you're also talking about making sure you can, engage on volume of disbursements. So like when you're thinking about optimization, what were the actual activities that you were looking to bring that incremental change to? Was it that you were inundated with so much volume of interest that you didn't have necessarily origination or qualification technologies to take that
No,
on?
actually
Was
the
it something
opposite.
different?
It's
Yeah,
actually the opposite. There's a lot of hesitancy and on like purposeful hesitancy on our part to not advertise our services
got it.
because we knew the implication. We didn't have the infrastructure to deal with it. We knew the demand
Sure.
was there, but don't tell anybody about it
Yeah,
because
it's like the
just
it's like the
don't
best secret in
like
Washington is,
yeah, just like don't
there's
don't
WACIF who has like a tranche of capital ready for small businesses to light it up,
but
but you can't.
we
Yeah,
can't churn it. So that was sort of the reality because of
yeah,
the we knew that if we told folks about and advertise our services in any real way, that we just would get inundated and it would be a hit to the brand because it's like, oh, they're the folks who are so slow that can't get a loan out the door. Like you don't want that. So we knew that we had to get our cards in order internally first,
hmm
and then go out to market and say, okay, guys, we're ready for this. Um, so yeah, like it was I think that going back to the business model of how we like this question of financial sustainability, like the world that we've lived in over the last 3 years, coming through George Floyd's death and the pandemic, which for institutions like CDFIs, this has been a time of growth because there's a lot of resources, a lot of attention, but how many CDFIs out there have the internal guts to really utilize that opportunity and scale what they're doing. So for us, it was we had to change the way that we underwrote loans because what we were doing was we were underwriting a loan like many CDFIs do. We're underwriting a loan like a bank would. We're spreading financials and this sort of thing. But the question is to do that. This is the fundamental reason why banks don't do this is because the time and energy it takes to do that, it's not economically viable. And this is what the international space was able to prove was, hey, we can do, and at that point in time, back in when Muhammad Yunus was doing his thing in Bangladesh, this was like group lending. And that's how most of my career was international careers in sub-Saharan Africa. And that's where group lending took off as well, especially in the early days of my career there. It was a lot of it was group lending, and it was this social collateral and group like where group members guaranteed other group members and this sort of thing. And that's how that was the model that was proven, and it was proven to scale, and it proved. And now what you're seeing now is banks saying, "Hey, wait a minute, these institutions are actually profitable and financially sustainable. And so why don't we get back into that?" And it's like, well, that's what you should have been doing all along.
And
And but
you're talking about banks deploying capital
exactly.
through small business lenders like WACIF and others. Got it. Yeah.
Or even on the international space, like banks serving the markets that
hmm
they didn't serve. And so then bringing into question the viability of microfinance institutions because why they were there because those markets weren't being served. But if banks are serving those markets, well, isn't our job done now? Because we've kind of that was the whole point. So anyway, but that's because they proved there was a proven business model to deliver capital to folks who were excluded from formal financial systems. So in in the CDFI space, that hasn't been proven yet. But the only way that I think it's possible is if you change the way that you underwrite. You cannot continue to do the same thing and expect something different. And so the hiring of Valerie Kint, who was a former colleague of mine at Axion, I did some work for Axion back in the day, and she had done a lot of this work with huge institutions around the globe. with millions of clients. And so taking some of those lessons from the international space and bringing them into the domestic space can start to change the dynamic. So if we say, well, to be financially sustainable, we need to churn more volume, so our cost per loan is a lot lower than it was before. If we move the way that we underwrite to cash flow underwriting, we can actually and automate a lot of the activities. We can actually lower the type of staff profile that we need to actually underwrite a loan. So at the same time, during the pandemic, you saw a lot of resources coming into the space. You also saw at any given point in time, you could type into LinkedIn jobs, loan officer in the Washington, D.C. area for CDFIs, and it'd be a dozen different postings that were available. So everyone's looking for the same skill set because everyone's doing the same thing. So what we said is, hey, if we can change the type of work that's being done and needing to be done by a loan officer, we can do this at a cheaper cost. We can drive scale. We can create more financial self-sufficiency in the process as an institution. So when the day comes when resources start to dry up or the administration changes and there isn't as much government money flowing to CDFIs as there has been, we're in a better position because of the changes that we've made kind of earlier on. So some of it's a risk management strategy from an institutional, institutional perspective, but it's a resiliency
Mhm.
mindset as well from an institution. We want to be the institution that continues to serve the Washington, D.C. area over time. And you got to be able to create organizational resiliency to do that.
Gotcha. And you talk specifically about cash flow underwriting, transitioning towards cash flow underwriting. I'd love to hear a little bit more about what that transition looked like. You were talking about how you were kind of doing the classic underwriting that a bank would do, but you were moving in a direction, cash flow underwriting or otherwise. What about that new underwriting approach is different, that it holds promise to bring those unit costs down? What about cash flow specifically or similar types of underwriting changes that have happened in your organization, allowed for greater speed, time to close coming down, things like that. I'd love to hear a little bit about what you see in it and how you're leveraging that differently to achieve
Yeah.
those objectives.
Yeah, and one of the fundamental things that we said to ourselves in these conversations is, okay, we're spending a significant amount of time, sometimes like 30 plus interactions with a borrower based on financial statements that they've put together for a small business. And then we're using those financial statements to like spread them and all these sorts of things. The fundamental question that we ask ourselves is that adding us any value in this, like ultimately when you're underwriting, you want to work the borrower through a process where you can get comfortable enough to make a loan. How you do that is completely up for debate. There's many different ways to do that. Traditional underwriting being one of those. So we came to the conclusion that for the amount of time that we're taking to do this and the quality of the data and the quality of the financial statement, these are not always CPA prepared statements.
Right.
And not every small business owner is an accountant. So the quality of financials is questionable from the beginning, just based on the realities that we're working in. And so what we said is, no, that's not the value of doing all of that work, knowing that you're potentially leaving out a vast array of other clients you could also be working with, is not adding any value to the decision-making process of whether we'd make a loan or not. So once you make that decision, you can kind of check that old underwriting method at the door, because we all agree that, you know what, we're doing all this work, but for what? Like, it's not adding a ton of value. So what we said is, okay, we care about inflows and outflows because it's going to be cash flow that pays off the loan. And from an inflow perspective or from an outflow perspective, we don't necessarily care whether you spend that on rent or on a gas for your vehicle or on supplies in your office. All we care about is that bottom line. And that essentially condenses all of that complexity that we otherwise were spending so much trying to figure out, and probably not doing a great job of figuring it out anyways. And condensing that down to a very simple way of looking at things, where it's like we care about cash flow, we care about debt service, and how we get to the final conclusion of that is obviously up for debate in terms of the methodology. Do we include, this is one of the debates that we had early on, is like, do we include an initial cash balance that the borrower had sitting in their bank, kind of at the front end of the cash flow analysis that we're doing, because that's real cash. We don't want to put them at a disadvantage by not including it. And there's a number of other factors that we looked at. So not only looking at it from a business perspective, but looking at it more globally, because we know that entrepreneurs often commingle activity.
Yeah.
The family is often the business, and the business is often the proprietor, and all these sorts of things. So we look at global cash flow as well, and in our kind of credit box, if you would, kind of the business debt service and the global debt service is two different things that we expect to be in a certain range, but wanting to kind of take the more holistic view of the client as part of the analysis.
Certainly. And so it sounds like, kind of a cash flow underwriting posture is like a back to basics, but simple is best approach when you're looking to optimize, let's say, for speed or to keep up with demand. And accessing or having visibility into cash flow is also a challenge, however, right? And so I'm curious, how did you take on both the opportunity or potential challenge of moving in the direction of a new type of underwriting workflow, but likely having to consider technology changes, other different types of systems that would allow for you to really focus on and engage on this type of underwriting style? Was there an infrastructure question that came with that?
Yeah, and it was interesting because like this project, this what we're calling our lending and redesign project,
Sure.
Was often referred to even internally as a technology project. But it was, the technology is the easy part, relatively speaking. It's the change management, it's the process reengineering, it's all of that. It's the policies, when it's the policy development when you didn't have kind of robust policy that really kind of allowed for scale. I think the hallmark of CDFIs is CDFIs like to be bespoke in their operations, to be able to serve that next client. It's difficult to scale using a bespoke sort of approach. So the analogy that we often kind of refer to internally is we want sort of the Autobahn highway approach, where there's a slow lane for the folks who need to walk through the process, but we don't want, and in my international days, I traveled a fair bit in Europe, and I gained a deep appreciation for the high speeds that folks would travel on different roadways, as opposed to in the United States, where you get the person like going below the speed limit in the fast lane type of thing. So we taking that approach is really like, okay, let's have different lanes for folks. Let's create ways to get people who are really ready now through the process as quickly as possible. And those who need more time can take more time. And that's really, that's where the technology piece came in, as well as the process reengineering. Like, we had to create the process that allowed for that. And then obviously once you kind of figure out the process, and you can go and build it on the tech side. So a lot of, even on the change management side, a lot of the work that we've done is helping folks within WACIF to understand that this is bigger than technology. This is change management. This is mindsets. This is approaches. These are deep rooted approaches that we may have used our entire careers, and that we have to think differently about this. And that's an ongoing process. and it's training folks in new ways to do their work in ways that they have never done it before. So the first part of the first kind of big milestone, if you would, for us that we kind of launched this thing internally was a new credit workbook that we developed internally, and that what the team was able to use to start kind of working through without any of the integrations that you would need. And we've like subsequently leveraged Plaid integration. So all this bank data is coming in automatically and it's all getting categorized as revenue or expense, so inflows, outflows. And this is all kind of, what we end up with is a couple lines, inflows, outflows over quarterly periods of time over 2 years. And this is what we're using to inform credit decisions. So yeah, it's a lot of, it's that change management. It's that kind of the new structure of our lending function from a personnel perspective. So
Gotcha.
how do you realign skill sets and when there's new roles in place and this sort of thing. So that it's an ongoing process, but one that, and it's one that we've been in for 2 years now. But this is, I think, like I mentioned earlier on, it's a mindset thing. This change process is never going to be quote unquote done, because once this project's done, the next project
Then,
needs to begin to
or it's yeah,
to
it's gonna, there's like
continue to,
there's a line of stuff that you want to be able to get
because
to for
you're
sure.
always not, even now, like even with our tech build that we have, there's things that we want to change, because it's
Hmm.
like you get into it, you realize that, wait, when clients are getting held up at this step in the process or what have you, and you're building the list of the next iterations that you want to do, and just to continually reinvent ourselves and reinvent the solutions that we provide.
Totally. And so maybe one last quick question on change management generally, but if technology is one piece of the change management puzzle, where does data generally, fall into the overall process as well? And so it sounds like you're looking at cash flow data, bank transactions. That is not always easy to access. It's not always easy to verify. It's not always easy to kind of slice and analyze in the way you need it to be analyzed to make those credit decisions. What are some of the data sources that are kind of outstanding that you would like your team to be able to look at, or really aren't necessarily part of the process quite yet, but which you have plans to kind of incorporate over time?
Yeah, it's so I think data in general, even in our manual process, we had a lot of data. The question is, where's that data sitting and how is it
Hmm.
being used? So we've always had a lot of data. I think the one thing that I would say is in this process that we've gone through, we've analyzed every single data request from the client to ask, does this help inform a credit decision? If not, it's done. It's
Mm,
out. We're going to focus only on what we need to make a credit decision, nothing more, nothing less. And I think that some of the challenge or the balance there is the way that CDFIs are historically funded. You have to collect all this data because you have to report it to grantors or to different funders. But that's a reporting conversation. That's not a credit decision conversation. Um, so I think from a credit decision perspective, like we've tried to simplify that as much as possible to get the
less is
cash flow
more.
data.
Yeah.
Less is more, but I think there's like, so if you're talking about Plaid integrations for bank
Hmm.
data, like LexisNexis, risk view type of reporting, business credit reports, these types of things. This is what we currently have that are informing credit decisions. Some of the stuff that we don't have, are things around like geo coding of different types of deals that we do. And this is more on the reporting side,
Sure.
but where
Yeah.
a lot of like manual type of activity, either because the integration doesn't exist yet or that we don't have it yet or what have you, some of that geo coding of different types of transactions to know whether the clients that we're serving are in marginalized communities or not, or whether like these types of things that can help on a reporting perspective, but also help
Hmm.
internally for a strategy and knowing that you're kind of hitting your target market and these sorts of things.
Gotcha. And I guess maybe as we close the conversation, I'm curious if there are any Kevin Fryatt hot takes for what's to come, 2024 small business lending in the United States. Are there larger transformational shifts that you see occurring that are going to ramp up? Are there some headwinds that'll also pick up and maybe create larger barriers for lenders to contend with? Would love to hear any closing thoughts.
Yeah, 2024. I guess what I would love to see and what I think needs to happen is some of what I explained or described earlier, where um, some of these things have already happened. Like there are industries that have scaled doing
Mhm.
this type of work. This is not new, but it might be new for the CDFI space. Um, I think the CDFI space would be doing itself a disservice if it did not explore and look at what's already been done in different parts of the world. And I think this is kind of where my international experience um, really comes to bear, where and not just underwriting methodologies, but different initiatives that the industry has created to support the industry, whether that's
Mhm.
visibility into different methodologies, toolkits that have been created that standardize approaches to different things, bringing investors into the same place for standardized reporting or just standards development and this sort of thing. Um, I think the CDFI space would be doing itself a disservice if it didn't explore what's been done elsewhere and knowing that there's no cookie cutter solutions, but there are examples of things that have worked elsewhere and
Mhm.
that could very easily be brought to bear within the work that we do here domestically. So standard setting, different ways of underwriting, technology solutions that have worked, partnership models that have worked in the past, these sorts of things. Because I think the goal is getting capital in the community in a responsible way. And to the degree that you can do that, I think it's our responsibility to explore what the options might be to do that.
Awesome. Well, thank you so much, Kevin, for joining Capital Compass. So appreciate your thinking, and really, really, excited to have you on in conversation, and looking forward to a solid 2024 for WACIF.
Yeah, appreciate it. Anytime, happy to participate.